Most people don't realize that there are 6 indicator components that identify whether or not we've gone into a recession. We're going to talk about what those 6 items are, what it means, and how it's impacting the stock market right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
There's a tremendous amount of speculation and talk about whether or not the United States is heading into a recession, or some would maybe argue already in a recession. And the reason that can get really confusing is because there's no single indicator that tells us that we are entering into a recession. Now, there are a few little cheats here and there, little Cliff Note versions that some people will reference, but the reality is there are 6 different indicators that are assessed by a committee, an actual group of individuals, and they identify whether or not we've gone into a recession. And that's one of the reasons that you don't usually find out in real time that we are in fact in a recession. Normally what happens is they're looking back through the rearview mirror and they're saying this is when we either went into or came out of a recession. So I'm going to explain to you how that looks, how that works, and those 6 components. We're also going to talk about the market and how it's digesting all of what's going on around us. We're going to look through capitalization lens. We're going to look through a lens with sectors. We're going to look at the bond environment, and we'll also look at some international. So we will be reviewing data as it ended last Friday, March 10th. Let's jump in. Now, as I mentioned, there is a group that actually is in charge of all this. It comes from the National Bureau of Economic Research, and most specifically, it's what's called their Business Cycle Dating Committee. It's a collective of individuals who are actually appointed to this committee to get together when it appears that the numerics would have us moving toward a recession or coming out of a recession, to identify these things. And these are individuals who come out of academia, they come out of the economy, or economics, I should say. They come from various other corners, if you will, of the different specialists that may have quality input on this subject. Now, most specifically, this group was founded, or this research group was founded in 1920, and these studies can present data and research findings, but may not make policy recommendations or make normative statements about policy. So it's supposed to not be a political beast, but that's for a whole nother discussion. Let's talk about a recession now. The definition defined by this group is that recession is a decline in economic activity that's spread across the economy and lasts for more than, quote, a few months. Now, a recession is also defined as the period between a peak of economic activity and a trough going down to its lowest point of economic activity. So as the graphic here would illustrate, if we're hitting our peak here and we're hitting our trough down here, then this gap in between, this grayed out area, would be indicative of, or would be illustrating the fact that we are in a recession. Now, as I mentioned, there's actually 6 indicators that they look at to come up with this and identify if this slope is, first of all, even taking place. So just as an example, let's take a look back at the financial crisis. So here we are looking back at 2007, 2008, and most specifically, these 6 subsets or 6 indicators identifying the different components of the economy. So we've got everything from personal consumption to employment to income, sales, production, as well as payroll, all employees, non-farm. They're looking at all of this and they're saying if these things are all trending downwards, then that would be an indication that a recession is either upon us or has occurred, like I said, looking through that rear view mirror. So here you can see, as the graphic is circled, it's really kind of showing this general downtrend taking place with all of these. And it really can get exaggerated if you look at 2020. So when the lockdowns took place in 2020, again, these same 6 items, Look at that drop that we saw between February and April of 2020. So they've actually determined that we were in a recession. It was really short. We were in a little quick mini recession during that period of time. And then things, as you can see, kind of bounced back up moving through the remainder of 2020 and into 2021. But if we move that forward and we look at, well, what's going on with gross domestic product? And the reason I bring that up is many people consider GDP to be kind of a little cheat sheet, a little cliff note version to identify whether or not the country has gone into a recession. This is not an official way of doing it, although you will hear this in the media where they will say, if we've got 2 quarters of decline in GDP, then we're likely in a recession. The key term there is likely, because again, GDP being total goods and services produced by a country or a nation, in this case, the United States, if those are going down, then likely all of the things on the previous page, those 6 items would be going down as well. But look what happened here in Q1 and Q2 of 2022. We have GDP negative for both those quarters. So again, some would think recession. But look what's going on with payroll. It was running quite hot, quite high. So that's also one of the reasons that you're seeing that we're getting to these inflation discussions. Because remember from our previous discussions, the Feds are raising interest rates. And one of the things they keep watching is employment and payroll. They want to see that coming down because that indicates some cooling off, if you will, in terms of what drives inflation. So you can't just count on GDP. You have to actually look at the overall picture. And again, this business cycle dating committee takes into account primarily those 6 items that I just discussed there. So then the question becomes, well, how is all of this, if we're thinking that this is the environment we're swirling around in right now, and that all of the media is identifying whether or not we're going to be heading into a recession, or maybe we've already entered a recession, but the committee hasn't determined it yet, what does all of that make as it impacts into the stock market? Well, at first, if we start looking at it through a lens of capitalization, everything from small cap to large cap, keep in mind we talked a few weeks ago about the fact that in the short term, in what we call the nano, we were getting all red. We're still getting all red here. And it's actually advancing because as you can see now, the overall stock market, as indicated by the Vanguard Total Stock Market ETF, it has actually gone just barely negative. It's dropped below 0, and we are seeing about half of the items here are coming in, or the various capitalization subsets are coming in at a negative number. Now, this tilt line that I've just put a little rectangle around, that's taking together kind of the overall view from macro down to nano. So from a high altitude to a low altitude, and where is kind of that hedge or that overall aggregate average. When we add it all together, if we're adding nano, micro, meso, and macro together, you're getting negative numbers running from the S&P 500 here down below. And again, on the nano side, we're getting all these reds. But look at all the green that we're seeing here. So what that tells us is the nano is very strongly red. It's actually, in this case, outweighing the other greens that you'll see, the other green dots here. So if we're looking at very high altitude view, macro comes down here. Look at all that red. That was all the market coming down to here. And then we see some green starting to take off, and that was coming right through here. But this little stretch in market performance, that's what we're seeing with this flash of red, this heavy red on the nano. So the market has been moving towards a bearish tilt. We're seeing it tipping that way. We don't know if it will continue to fall the whole way or if it will right itself, but it's definitely starting to have a short-term trend where it's been tipping or tilting bearish. Now, if we look at this from a sector viewpoint, and again, there are 11 different sectors that make up the S&P 500 or the overall market for that matter, and we look at all of those, again, we're seeing the average weighting of all the sectors is coming in negative. Now, that makes sense because we said the overall stock market was coming in negative. So this makes sense. But within that, there are certain things that are either buoying the market up or dragging the market down. The things that are kind of buoying it up a little bit are technology, industrial materials, and so on. What's really pulling it down are energy, utilities, and healthcare right now. So look at down here, we've got all solid red at the bottom. And up at the top, we're not getting solid green because we're getting this nano line, which is also all red. So the overall looks very similar. We've got a lot of red coming in down here on this macro. And then on the nano right here, we're seeing this red coming in right here. Even though we had green down here, it's offsetting it. And that's being depicted up here in the overall market performance. So again, tipping towards bearish, building momentum in that direction. We're seeing a lot more red here than we did in our previous conversation. We don't know, obviously. You have no crystal ball out there to predict where things will go, if it will turn back the other direction, but the market has definitely been tipping towards the bear. Now, in the bond environment, kind of unique as well. In the bond environment, again, this chart works the same way, and here's the overall bond market. Up until just very, very recently, what we've been seeing is corporate bonds have been essentially lifting the bond market. And down here, you'll see mostly government bonds was bringing it down. But look what's happened. The long-term government bonds have jumped all the way to the top of the list. And they're the only two that are giving us green on the shortest view sliver of time, which is nano. So very interesting because if I remember correctly, I believe 2 weeks ago when we were talking about this, all of these were red. But we are seeing the 20-year and the 10, basically the 10 to 20-year and then the 20-year plus on Treasury bonds. We are seeing that starting to tip a little more bullish, although overall, as you can see by all this red, all these negative numbers, the bond market is definitely been trending in a bearish environment. And then our last view here is international. International is looking similar to here in the U.S. right now. We've got a full column of red on the nano, but we are seeing overall still some positive. We're not in the negative red here. We are seeing some positive. So it's right now telling us that the international is performing a little bit better than we are here domestically. We don't know if that's going to be the case moving forward or if it will trend back the other way. But take a look at the macro down here. You've got just solid red, and then all of a sudden it goes green up through here. Now, they too are seeing red in the nano. So we don't know the power of that and the strength of that, if it's going to turn this the way it seems to be turning things here in the U.S., or if internationally it's going to pull back the other direction. So lots going on. And this is, again, why we're hearing so much talk about, obviously, we're dealing with inflation and the Fed's raising interest rates. We've talked about that numerous times in the past, but also the fact that the Feds keep saying that we may need a recession to get interest rates and to get inflation back in line. And right now, there is a lot of talk about the potential of that recession. So keep in mind, it's not just 2 declining quarters of GDP. We've got to look at the bigger picture.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.